What is up, everybody? Spektrades back here with another video. And yes, the thumbnail was clickbait. We do not buy at premium and we do not sell at discount. In this video, I'll be going over in depth on premium, equilibrium, and discount on how we find trades and how we enter our trades. Before we get started on the video, make sure to give me a follow on Instagram at Spektrades. This is where I am most active at. If you have any questions, make sure to give me a DM on Instagram at Spektrades. Let's hop back in the video. So first and foremost, we have our schematics right here just to make things simple before we hop on the charts. So we have our low, just to mark our range, our market structure. We have our low, and then we have our higher high, and now we have our higher low, and then we have our higher high. So this is in a uptrend. And this right here for the sell format, we have our high, and then we have our lower low, and then right here we put our lower high, and then right here is our lower low. So before we even get into premium and discount zones, we have to understand what structure we in, right? So right here is a bullish market structure, then right here is our bearish market structure. Now that we know what type of structure are we in, we will grab our Fibonacci, and then from the low to the high, that's where we will mark our Fibonacci. This is just the basic Fibonacci settings, 0, 1, and 0.50. 0.50 is our equilibrium, which is the equal price of the range. So we're just gonna grab it from the low to the high. And for us to find a trade in a bullish market structure, we have to wait for price to cross our equilibrium to tap into a point of interest inside our discount zone. And then for us to catch a trade in a bearish format, we have to wait for price to cross our equilibrium and then tap into our premium zone. So right here is our discount. Make this green. Then here is our premium. So once price cross our equilibrium, our 50% price, which is the equal price, we then sell high, right? We then find a order block or a fair value gap or a type of interest, right, to then sell down lower. And then for us to go higher, we'll have to find a point of interest or a PD array, as ICT called it, right? A PD array inside of our discount zone. This will be our point of interest for us to go higher, and our take profit will be the high of the range. So the low of the range is the 1 and the high of the range is our 0. So once price crosses the 50%, we'll find a trade, we'll find a point of interest inside of our discount zone to then go higher. Well, we'll just place our entry, stop loss at the low of the point of interest, and then what we're targeting, we'll be targeting the old high right here. Boom. And then for our bearish format is the same exact thing. We'll wait for price to cross our 50% of the range to tap into a premium zone, a premium PD array, either an order block, a fair value gap, or any type of point of interest, right, that we'll be going over, to then what we're targeting, the old lows. Boom. So we buy low and sell high. This is just a basic format of it, a basic schematic. But this right here is truly important right here. This phrase right here. Whenever you whenever you're doing your markups, your top-down analysis, always look at where is structure at. Are you in a discount zone or in a premium zone? We buy low and we sell high. This right here, just this phrase right here, will save you a lot of money, right? Once you understand this right here, this will save you a lot of money, because if you haven't, so once you have clarified your range, the low and the high of the range, you have to wait for price to cross the 50%, right? A lot of people might see a good clear order block right here, but price haven't crossed the 50% yet. So you have to wait for price to tap into our discount zone before we go higher. And it's the same thing here for our premium zone. Price might give us a clear order block or a point of interest right here, but price has to cross the 50% of the range before we can go lower. Right here was just a quick schematic of our premium, our equilibrium, and our discount zones. Now let's hop on the live charts and see if we can find us a setup in action and just redo this on the live chart so you can just see it more clearly. Now that we're back on the charts, the first thing we have to do is assess our range, our structure. Where are we at on a structure? Right here we can see that price took liquidity from these old lows, purged these old lows, and then went and gave us a breakup structure of the high that took the liquidity. So our low of the range is from here, and then the high of our range is here. So for us right now, we are in a bullish market structure, just like we showed in the schematic. So what we'll do, we're just gonna grab our Fibonacci from the low and then place it at the high. You can either use the bodies or the wicks. Either one matters, right? Either one don't really matter, right? It just depends on which type of chart platform you're using. So right here, I'll just be using the wicks. So as we can see here, here is our discount zone. Here is our premium zone. Just like we state, this is a bullish structure. So because this is a bullish structure, we have to wait for price now to cross our 50% of our equilibrium and find us a point of interest inside of this, inside of our discount zone before we go higher. So as we can see here, what type of point of interest do we see? We see price has left us this fair value gap. Price will have to come back and attract to this fair value gap. And price left us this beautiful bullish engulfing order block. So this is a bullish market structure. We have to wait for price to come back down here before we go back up here. So let's play price. Remove this, put it up here. And then we see that price tap into our point of interest inside of our discount zone. What will our stop loss be? Right at the low. And we're targeting our old high. Boom. 48122. So this is our trade in a bullish format, right? We wait for price, just like we stated in the schematic. We wait for price to cross our equilibrium, our equal price of the range, to tap into our discount zone, and then to tap into our point of interest, which was this bullish engulfing order block, to then go back and clear our old high, the top of the range. So this was our premium and discount zone in a bullish scenario. Now let's go look for a premium discount zone in a bearish scenario and how we can take a trade. And now we'll be looking for a bearish scenario for our premium and discount zone. So first we have to assess our range. So we see price took liquidity sweep of these old highs and mitigated a point of interest inside of this. So liquidity sweep. And then price comes and gives us a formal breakup structure. And then what we do, we grab our Fibonacci from the high of the range and to the low of the range. So this is our discount. Right here is our premium. As we know, in a bearish format, we wait for price to cross the equilibrium to tap in a premium zone before we go back lower to clear the low of the range. So we're not going to look for a trade in discount while we are in a bearish format. We'll wait for price to cross the premium and then we'll go for lower prices. So right here, what type of point of interest do we see in our premium zone? Right here we see our point of interest. Right here we see our fair value gap. I have a in-depth fair value gap video coming out soon. So for our point of interest for fair value gaps, when I see price come and tap into our fair value gap and go back lower, so go back lower, or we might see price fill the fair value gap completely and tap into our IPA, our inefficient price action, before we head lower. So how do we take this trade? We'll place our entry right at the open of the fair value gap, or you can use the 50% for a better risk to reward. You can grab the 50% of the fair value gap and place it here. And then to just be safe, we'll place our stop loss at the high. So you can either take the trade at the 50%, or not this. You can either take the trade at the 50% of the fair value gap or the open. Me personally, I would take the I always take the trade at the open because sometimes price don't really cross the 50% of the fair value gaps. So just keep that in mind. So me personally, I usually always place my trades right at the open of the fair value gap, and then I place my stop loss at the high just to be safe. You can either put it at this high too, just to be more just for more RR, I would say, but to just be more safe and just catch you just a for sure trade, right? Because price might also cross and tap into deeper into this IPA before we go lower. So me personally, I always place my trades right at the high, and then what we targeting, our old low, boom, 4A122. Now let's play price. As you can see, price tap into our fair value gap. Now we're in our trade. Price might have filled the 50% perfectly. It kind of reached it, right? It kind of reached it. That's why I always advise you put your trade right at the open of the fair value gap, because price might come close to the 50% or just might tap into the open of it before heading lower. So just for you to be inside of the trade and just not to miss out, just place the trade right at the open of the fair value gap. And we're targeting our old lows, and price hit our take profit. So this was our trade in a bearish format. The previous one was in a bullish format. I hope you guys finally understand premium and discount zones and how you use them to take trades. I also have released a free course down below where I go in depth on all these concepts in depth, where I explain market structure, fair value gaps, change of character. It's a free course down below. It's just an hour long. Go through it, understand all the concepts, and just look through it even more. But without further ado, this is it. Spektrades out.